The 10 investing mistakes even smart people make. Clapperboard introduction. Even smart investors think investing is a game of intelligence. Read enough books, watch enough videos, and you will win. But here is the bitter truth. Some of the worst financial mistakes are not made by beginners. They are made by people who are known as money literate. Why? Because investing is less about knowledge and more about behavior. In this video, we will uncover 10 hidden traps that quietly destroy wealth, even when many think you are money smart. Chart increasing 1. Trying to time the market. Everyone wants to buy at the absolute bottom and sell at the very top. But no one actually knows when those moments happen. When panic sets in during a crash, many smart investors sell everything. They plan to wait for the perfect time to buy back in. But they usually miss the recovery. The market does not ring a bell before it rises. In fact, some of the best performing days happen soon after a worst crash. If you miss just a handful of those powerful days, decades of your returns can vanish. The goal is not perfect timing. It is how long is your stay in the market. Brain 2. Falling for the overconfidence bias. Knowledge creates confidence. But too much knowledge can create overconfidence. Many money-literate investors begin to believe they have discovered information that nobody else has. They say, "I have done my research," and begin trading rapidly. But remember, every time you trade, you assume you are smarter than the entire market, which is already pricing that asset. Frequent trading rarely beats the market. It simply generates more fees and taxes. Ego has no place in investing. The stock market rewards patience, not overconfidence. Globe showing Europe Africa 3. Nurturing a home country bias. Most investors believe their portfolio is well diversified. Look closely. You will find every single stock, bond, and fund might be from your home country. It feels safe to invest in what is familiar. However, your local economy is only one small chapter of the global story. Economic growth shifts across continents. Concentrating all your wealth in a single nation increases your risk. True diversification is not just about owning different companies. It is about owning different geographies. Money with wings 4. Ignoring the impact of taxes. People spend hundreds of hours searching for market-beating stocks. Yet they completely ignore taxes. Every unnecessary sale and poorly planned investment creates a taxable event that slashes your returns. Your actual investment return is not what you earn on paper. It is what you keep after taxes. Successful investing requires minimizing all those silent leaks. Racing car 5. Chasing past performance. It is easy to confuse a trend's past success with its future certainty. When an asset has already surged, it suddenly feels like a safe bet. But yesterday's winners are rarely the winners of tomorrow. By the time an investment makes the front page headlines, the biggest gains are already gone. Buying out of excitement means buying at a premium. Great investors do not chase old returns. They build consistent discipline. Anchor 6. Getting caught in the sunk cost trap. Nobody likes to admit they made a mistake. When an investment plummets, many people hold on to it simply because selling feels like admitting defeat. But money already lost is gone. The length of time you have held an asset does not change its future value. Ask yourself one question: if I had extra cash today, would I buy this asset again? If the answer is no, your portfolio already knows the truth. Your emotions just need to catch up. Cyclone 7. Chasing complex asset classes. Complexity does not mean safety. Many money-literate investors believe that exotic, highly sophisticated investment products offer better opportunities. In reality, complexity often hides severe risks that only surface during a market panic. Never invest in something you cannot easily explain. If you do not fully understand how a product makes or loses money, you should not own it. Balance scale 8. Ignoring to rebalance. Ironically, your own investing success can create new risks. If one specific stock performs exceptionally well, it might grow to make up, say, 70% of your entire portfolio. When this happens, you are no longer diversified. Rebalancing feels uncomfortable because it forces you to sell a winning asset. But that is exactly what risk management is. It is not about predicting the future. It is about making sure a single downturn does not wipe you out your investments. Magnifying glass tilted left 9. Underestimating investment fees. A 1% annual fee sounds completely harmless. But investing is a game played over decades, and compounding works both ways. While your returns compound, your fees compound too. Over a lifetime, that tiny annual percentage can quietly absorb hundreds of thousands of dollars from your ultimate retirement savings. The most expensive investment is not the one that loses money on a trade. It is the one with hidden, ongoing costs that drain your wealth every single year. Fire extinguisher 10. Locking up your emergency fund. Investments are meant for your long-term future, but emergencies happen in the present. Even highly money-literate people often put every single dollar into a liquid investments, assuming they will never need cash immediately. Then, an unexpected medical bill comes up, or a job loss occurs. Without cash on hand, you are forced to sell your long-term investments, often during a market downturn. An emergency fund is not idle money to remain locked up in chests that may remain unopened for a long time. Understand, it is the financial shield that protects your long-term portfolio from forced liquidation or redemption. Direct hit conclusion. The more you learn about money, easy is the temptation to believe you are immune to these 10 basic mistakes. That is overconfidence. But the market does not reward overconfidence. It rewards consistency, patience, and emotional control. Building wealth is not only about making brilliant decisions. It is more about avoiding catastrophic mistakes. The goal isn't to beat everyone else. It's to avoid beating yourself. If this video helped you rethink your investment strategy, please subscribe to A to Z Money for more thoughtful guides on making better financial decisions. Thank you for watching.